Our M-Life question of the day, it's fairly simple, fairly straightforward. Which one of those is going to offer you the greatest trading opportunity? Is it a touch of Brexit? Maybe the pound is already prevaricating. Could it be a touch of German politics and the bunds? Or Italy? Is low spread on your agenda? Eric Lonergan, make your pick now. Lights down. This is your moment. M&G Investments. Which one would you trade with the greatest bang for your buck this week?
Well, I wouldn't. Trade would be the wrong term for me to use, but I think there are two investment opportunities that are coming out of this. One is in Italian equities, particularly in the well-capitalized Italian banks, which I think went into this phase on reasonably compelling valuations. And I think you've seen very, very aggressive negative price action on the politics, which I think in the grand scheme of things we're going to look back on and is probably going to prove to be, more sound and fury than actually anything that material in the medium term to Italy. I mean, the reality of underlying economic facts, the Italian economy is making a recovery. It's doing pretty well. Ultimately, European interest rates are going to rise, all of which is very, very beneficial for Italian bank earnings. So I think Italian equities are very attractive with respect to Brexit. I think the behavior of sterling is very intriguing. It's worth bearing in mind that if you look at cable, the lows were at around the 120 mark. You've had persistent bad news, I would say, on Brexit. The risks of no deal seem to have increased. However, it's possible here, it feels to me, to the extent that one can have any view on this, but the kind of move towards potentially a second referendum, or eventually, given the threat of a second referendum, then actually a deal gets approved.
Yeah.
I think here sterling is very attractive against the dollar, but that is something that may require considerable patience.
OK, so for Eric Lonergan, sterling very attractive against the dollar, but you've got to be patient. Richard Jones has been very patient, our Bloomberg MLIV strategist. He's also joining us from Berlin. Richard, let me ask you about Brexit, since we've taken it in that direction with Eric. Are the risks to sterling more to the downside this week, particularly as a lot of people are saying any moves to the upside could be capped because of the parliamentary risks in the UK?
I think on any given week it's difficult to take a pick, but I think over the coming months, I think the downside is still the weak side for the pound, because as difficult as it's been to actually get a deal with the European Union, and we don't have one yet, I think the more difficult thing, the bigger challenge for Theresa May is the parliamentary arithmetic to actually get this thing through the House of Commons. I think the difficulty there is that we could be heading into new elections. I think the uncertainty that new elections would bring forth would put some downward pressure on the pound, in addition to some of the negative consequences from Brexit, which I don't think are being fully priced into the interest rate curve or into the currency. I think that combination, to me, makes me a little bit more nervous about the downside in sterling rather than the upside.
Well, gentlemen and Nara, let's all join this conversation, because volatility, some would say, is not pricing in what could potentially happen by next March. So to you, Richard, would you think that we should be a buyer of volatility? And to Eric, the same kind of question. You talk about patience in terms of the pound, but where are we with volatility? Everybody's saying to me that Brexit and hard Brexit is still a risk and it's not being priced in sufficiently in the vol. Richard, first of all.
Yeah, I've been saying that for a few weeks, that I think that especially euro sterling, the short end of the curve, the 1 month and 3 month volatility should be supported. And as it turns out, they have been supported. But I think in terms of pricing political risk, I don't think the market is as efficient at doing that as they are pricing other risks. So I think once the political realities become clear, we'll see that jump in the volatility. For now, it should stay supported, but I think we actually need to see more concrete news before we see the really big pickup in volatility.
Eric, on that note, and it does centre around volatility,
yeah.
Let's go back to the MLIV question.
Yeah.
Where are the greatest trading opportunities out of these three things we've talked about: Brexit, Italy and German politics?
Well, I think probably in terms of, your potential for the highest returns are probably in Italian equities. And as I said, particularly in Italian bank equity. I mean, you could on a 12-month view make 40, 60, 70% out of those assets. I mean, they're on single-digit PE multiples.
Well capitalised enough to withhold the spread moving out to even 400? I know we're far from that now.
Not, you're going to get them cheaper if spreads move out to those kind of levels for sure. But I think what you've got to try and look through the noise. You've got to try and ask yourself, are the Italian Italians really going to precipitate a fiscal crisis? I think there's a lot of gamesmanship going on. These guys have just got into power. They're trying to sound quite aggressive, but the track record has been they typically backtrack. I mean, the Italians, it would be madness for them to try and precipitate a fiscal crisis. If you get any fiscal stabilization, or they sort of manage to get an agreement with the Europeans, you could see a very, very pronounced and aggressive rally in those assets.
Eric, it takes me back to what Mario Draghi said over the weekend, which is the first thing everybody's got to do is try and tone it down. And that includes all parties. So you say there could be potentially a huge opportunity, but do you think that there's a bit more pain to come in the low spread before you get that opportunity? We just looked at some of the buffers of capital in the banks, and most of them have a long way to go before you have real pain. But this is going to be a long road to the springtime of where they're potentially accused of being excessive deficit procedures. And even then, would it matter?
Well, that's the key point. I mean, people have got to stand back here and go 2% versus 2.4. I mean, 0.4% of the budget deficit in Italy is statistically trivial. I mean, the mismeasurement of the Italian economy is probably worth 15% of GDP. I mean, this is noise in the grand scheme of things. This is political posturing, and people have forgotten all of the good news. I mean, the good news is that the Italian economy has been recovering, broadly over the last 12, 18 months. Growth has been stronger than people anticipated. Ultimately, European interest rates are going up. I mean, the leverage of Italian bank earnings to higher European interest rates is extreme. So there's a lot that we've forgotten about that's positive. I mean, you'll remember in the first quarter this year, everybody wanted to own Italian equities, and the political environment was still pretty much the same as it is today. So the ability of the market's mood on these matters is to change, is there for us all to see. We know that this kind of things happens, and you're now getting extremely good odds when you look at the valuations.